Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Canada's merchandise trade deficit widened in January. Data from StatsCan showing the country's deficit expanded to $3.7 billion, driven by a drop in exports. Goods leaving the country were dragged lower by a sharp decline in shipments of motor vehicles and parts. Those exports fell to the lowest level since September of 2021. Shipments to the U.S. were down nearly 4%, while imports were also lower. The White House is starting a new process to replace tariffs struck down by the Supreme Court. The Trump administration has opened a new trade investigation into manufacturing in foreign countries, which could eventually lead to new import taxes. Trump has said he will seek to replace the hundreds of billions of dollars in lost revenues after the Supreme Court ruled against his use of IEEPA tariffs. Shares of NFI are rising after the bus maker posted record profit in its latest quarter. It's up nearly 6%, 5.8%. It also had higher revenue. Profit rose 79% compared to the same period the year before, topping expectations. NFI says the results were driven by strong demand and higher deliveries. For the full year, it expects demand to continue and projects revenue growth of up to $4.2 billion US. And another down day on the markets. You can see the TSX off. Energy prices can't pull it up. TSX off by about a half point, 0.55% right now, continuing that downward trend. South of the border, similar situation. Big sell-off going on right now. The S&P 500 up 1.25%. The Dow 1.33%, and the Nasdaq by 1.67%. Well, the price of oil has spiked again, renewing fears that the conflict in the Middle East will continue to reduce energy supplies and fuel inflation. You can see there, oil's up another 10% to 96 WTI. S&P futures and European equities are seeing some pressures as a result. Joining us now is Martin Roberge, Managing Director, North American Portfolio Strategist at Canaccord Genuity. Martin, thanks very much for joining us.
Thanks for having me.
It is a yo-yo week. We had that oil being released by the IEA. Doesn't seem to be having an effect.
No, and we have to remember that this will, we can move probably 1.5, 2 million max barrel a day. So we're talking about more than 100 days before we fully see those barrels into global oil markets. So obviously we need probably to see further announcements of further releases to move the needle, because otherwise what we're about to see, or what we're seeing, is that it's not so much what we call the front contract or near the what we call the cash market. We know it's moving higher, but the risk is that what we call the strip or the forward curve, we're seeing the 1 year price of oil now catching up and moving above $70. And if you look back at the Russia-Ukraine conflict, the one year price of oil peaked at around $100. So we're building those expectations that oil prices are high, or oil prices could stay higher for longer.
How long in 2022? How long did it take to get to that $100 a barrel?
Six months. So 6 months after the military strike. So around summer 2022, and that obviously was the ultimate peak. But just as a segue for energy equity investors, stocks, some investors are complaining that the stocks are lagging the commodity, but the stocks never trade in line with the front contract or the cash market. They trade in line with the 1 year strip. So to a certain extent, those that are positioned in the energy equities, it's good news, and that's just a reminder to have some hedges in energy equities, because if we're going to see the 1 year strip moving to 100, we're talking like about like a 40% move in the price of oil, and probably a 40% move in the price of the underlying energy equities.
And is this situation, I mean, it's very pronounced because we know 20% of the oil is coming through there. Is this situation worse than the Russian invasion because there was so much uncertainty on that as to where that would go? But is this situation worse, and could everything be sped up?
Yeah, it's probably like if you were to remove the situation with the Strait of Hormuz, it would be less of like a smaller challenge for oil markets. Like there's not going to be boots on the ground, and we know also that most of the emerging markets, especially China, we've built enormous strategic reserves, and very importantly, in 2022, the oil demand supply equation was totally different. And in 2022, the oil market was not oversupplied, was undersupplied. This time around, according to the EIA, we've got about a 3 billion barrel a day of deficit of surplus, by the end of this year, and 2.5 by the end of 2027. So we are in a surplus situation, while in 22 we were in a deficit situation.
So it really, you are of two options here, aren't you? I mean, things could calm down and all of a sudden we're back to a more normal pace, or if this continues for not much longer, it could force oil up and take advantage of it that way by looking maybe at energy stocks, I guess, that would be.
And energy equities, but at this time of the energy cycle, I think we have to be smarter and look for a broad basket of resource equities. And the reason for that is that if oil prices are to stay higher for longer, other commodities will do well, or will continue to stay strong. So we've got obviously fertilizer equities, copper mining equities. We're going to see a revamping of the energy infrastructure around the Middle East, that's for sure. There's going to be like more nuclear energy spending, infrastructure, renewables. And so we knew already about the energy transition driving demand for various commodities, but this Middle East conflict is adding another layer of forward demand. And so I think like it's not just energy equities that we have to consider, but probably a basket including agricultural stocks, obviously like mining and gold equities. It's the hard asset bucket that we need to focus on, not just like the energy sector.
And this could be a good opportunity to look at Canada then.
Obviously, yeah, because when you look globally at stock markets, we've got about 40% of our market in resource equities. This is the highest weight across various equity markets around the world. So that would be an opportunity. And the other opportunity, in my view, is the emerging markets. Those are not the same markets that were obviously struggling whenever oil prices would be rising, because as I mentioned, like this time around, China has a huge strategic reserve of about 1.2 billion barrels in inventories. Now India is going to get some reprieve from and be allowed to buy Russian oil. And as we know, LATAM emerging markets are net exporters, so they benefit from higher oil prices. And we've seen like a good performance last year by emerging markets, but this year we continue to see like a gradual re-rating and devaluation of those markets, which are still like trading at a 40% discount to DM equity market. So we like also our emerging market equities as a hedge against a prolonged energy crisis.
All right, we have to wrap it up there, Martin, but thank you very much for joining us.
All right, bye-bye.
Martin Roberge is Managing Director, North American Portfolio Strategist at Canaccord Genuity. Coming up, Descartes Systems sees some momentum after reporting a fourth quarter beat. We'll hear more from its CEO after this. Descartes Systems reported a beat in its fourth quarter, beating expectations across all key metrics and showing early momentum in its AI strategy. Let's get more now from Edward Ryan, CEO of Descartes. Edward, thanks very much for joining us today.
Thanks for having me.
Your revenue was up in a year that a lot of people may have been worried about where software and everything else was heading and what might happen to it. You had a good year. What did you do right this year? Or I should say in 2025.
Yeah, things are going great. There's a little turmoil in our industry, in the early parts of the year with all the tariff uncertainty, and people weren't sure whether they should ship or not. That's largely gone away now, and the new tariff regime in the U.S. is a lot simpler for people to deal with. So, that's been very good for us. Shipping's picked back up, and the number of transactions that we're processing gone right along with it. So that's been good for us. That's why you're seeing great numbers out of us. And then we had the other part of it where, we run the largest database of tariffs and duties and sanctioned parties in the world. And that's always been going well because people are trying to access that information on our network to try and figure out what to do. So that we had strong momentum there the whole year. Unfortunately, some of the tariff stuff at the beginning of the year slowed shipping down. But, since then it's been, last 2 quarters has been going great. And I expect that's going to continue.
And have you found that in some ways to be a bonus for you, the tariffs?
Oh, yeah. I mean, we operate the largest tariff and duty database in the world, largest sanctioned party database in the world. Most of the supply chain participants use our information to figure out what they're going to do, where they're going to ship it to and from. And every day those tariffs are changing. There's more reason for people to use our systems and help deal with the complexity that they're facing in the market. And that's been good for us all the way through.
And you're sitting on, I think, $356 million in cash and another undrawn $350 million in the credit facility. What are you looking to for the next little while with that money?
Well, we're a very acquisitive company. We always have been. With a lot of tech's been hit with AI concerns. We think it's a big tailwind for us and a big advantage for us over time. And I think you're going to see us continue to buy up assets in the space to take advantage of it.
And any particular any area you can talk about, or are you just kind of casting a wide net?
Well, yeah, we have a lot of stuff in the pipeline without naming names. I mean, some of the businesses we're in, all of the global trade intelligence business, it's about 20% of our business, is very attractive to us. Certainly, any network that competes with us in the logistics and supply chain space is something that we're very interested in. And our transportation management tools and supply chain visibility tools is a great space for us. There's a lot of assets there that we think in the long run might be a good fit for us. And then I guess finally the e-commerce space, where we've probably done 10 acquisitions over the past 7 or 8 years. And I think you'll see us continue to deploy more capital to buy things in that space because the first ones went so well for us.
All right, and now you called AI a tailwind for you. A lot of people were looking at AI as being a headwind for software. How are you incorporating it, and how do you see it as an advantage for you?
Well, first of all, people lump us in with enterprise software. I'd say we're probably more inter-enterprise software. We run something called the Global Logistics Network that processes transactions for our customers, and we think that gives us a proprietary set of data content that's going to be very valuable in the future to run AI routines against and agentic agents against, and it's going to allow us to provide a big opportunity for our customers to operate more efficiently and save money.
Now, you're running at about 15% of revenue, seat-based pricing. The agents, how are you going to work that all in together and grow it as the AI agents become more commonplace?
Well, it's 15% of our revenue. I think you might have said 50.
No, 50, I did say 15. Sorry, I didn't enunciate. 15, right?
Yeah, it's 15% of our revenue. It's a minor part of our revenue. We'll probably end up changing that as agents come into the space. We're probably going to provide our customers with a lot of those agents, and we may change the pricing for that. But understand, even today, a customer pays a certain amount of money per month. They have a monthly minimum. It's not something I think that we're going to have material change in that, and we probably will change the pricing model away from users. But again, it's only 15% of our business, and I think over the next 5 years you'll see that change to something more like transactional pricing, or look at a bundled package for the size of their business. And I don't imagine that's going to be a big deal for us.
All right, and you reduced headcount by 7%. AI, more and more AI is coming in. Do you see larger numbers than that over the next little while, or are you actually going to grow staff in some ways?
We're going to we're getting savings already from AI, and we just keep putting that money back into, we keep our employees and put our money back into putting more functionality out. And I think you'll see us continue to do that in the future. Whether we add because of it or not, I guess we'll see. But right now it's improved our efficiency quite a bit, and we haven't been using it to lay employees off. We've been using it to provide more functionality to the customers, and we think that's the right way to handle it.
And can you put a number on that, on the efficiency?
I probably shouldn't put a specific number on it, but it's significant. We're able to produce a lot more code right now and roll out functionality that 5 years ago might have taken us a year, and now we're talking a month or two to roll it out. And we have ideas, and they come to fruition much more quickly. We don't need as many developers to do it, so it's easier for us to do. We have more like product managers that are coming up with ideas, and they're able to do a lot of that work themselves. And so the nature of the work's changing a little bit, and I think that's a real positive for us, because we're able to do it much faster than we used to.
All right, and just one last question: the war in Iran and the impact it's having on oil and geopolitical tensions, is that having any kind of an impact on your company?
Minor right now, but I think you're going to see it have more of an impact in the future. These things put a lot of pressure on our customers. It increases transit times, and people usually end up using our systems more than they did prior to the war, to figure out what to do about it. These types of things have usually been a net benefit, and I suspect the same will happen here over the next couple months. We'll see how long the war goes on for. Hopefully it's short-lived, but if it goes on longer, our customers have to deal with it, and they use our software to figure out what to do about it.
Okay, Edward, thanks very much for joining us today.
Thank you, Roger.
Edward Ryan is the CEO of Descartes Systems. Coming up, today's Market Movers with Bloomberg's Monique Malima. Time to take a look at today's Market Movers, and we're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. And they say war is sometimes good for business. That's proving that for Nutrien, isn't it?
Yes, so Nutrien, their shares are up today after they've been seeing gains because of the war. A number of fertilizer companies operate in the Middle East and also transport their fertilizer through the Middle East. So they've been facing disruptions in order to move their product, and that's risen demand for Canadian and American fertilizer companies that aren't dependent on these routes. And that's why we've been seeing Nutrien shares rising. And because of this, Nutrien also got an upgrade today from analysts at Jefferies, who really see opportunities for the company to see growth in revenue off of this. They think starting probably around the second quarter, we're going to start seeing this show up in results. And they also think that this is coming at an opportune time for Nutrien. Right now, a number of farmers are starting their spring planting, so they need fertilizer now. And if they can't get that out of the supply from the Middle East, they're going to look to these Canadian and American companies instead.
Okay, and everybody, of course, has their eye on oil companies, gas companies, Occidental, one of them.
Yes, so Occidental, they are rising today with oil prices. Oil prices rose as much as 10%, and that's what's helping to lift the Occidental shares. They're in a similar situation where, because they're a North American-based company, they're not seeing those same disruptions that are happening in the Middle East, and as a result, there's more demand for their oil right now. We saw analysts at Piper Sandler and at Wells Fargo today upgrade the stock, saying that they see opportunities for them to be able to capitalize off this rise in oil prices. But they also note that Occidental has been improving its business outside of the conflict as well, that they've improved on capital efficiencies, that they see dividend growth in the future for this company continuing. So they're getting the benefit from the Iran war, but the analysts are also saying that there's some fundamentals for Occidental for why they should be seeing these share gains.
All right, another sector to be keeping an eye on, chemical. Dow, one of them. What's going on there?
Yes, so Dow, again, similar on the Iran war. A number of chemicals come out of the Middle East and out of the supply there. So again, for the North American companies, they're seeing some of the benefits of growing demand. We've seen this for Dow and its peers throughout the conflict. They also got upgraded at Citi today, saying that they see them being able to improve their margins due to the rise in chemicals prices that they can charge. So they see that this is going to benefit their earnings going forward.
Okay, Monique, we'll wrap it up there, but thanks as always for joining us. Bloomberg's Monique Malima. Well, Canada's trade deficit widened in the month of January as auto trade weakens. For more on these surprisingly soft numbers, we're joined now by BNN Bloomberg's Lindsay Biscay. Yeah, the numbers
pretty weak.
Down, yes.
Yeah.
I know they would kind of expected it, but boy, the auto sector especially.
Exactly, the auto sector, and we'll get to that in a moment. So, because I mean, it is a lot, wider, I guess you could say, than what a lot of analysts were predicting. So trade deficit widening to $3.65 billion. That's the number. That's almost 3 times higher than the deficit we saw in December, which was $1.3 billion. So we saw exports drop, imports rise. And as you mentioned, a lot of it is coming from the auto manufacturing, the vehicle parts section of our sector. That was the biggest kind of point that analysts are really honing in on today. We saw a drop in exports there, and they fell to their lowest level since September of 2021. Vehicle and part shipments fell 21%.
Wow.
And imports of vehicles and parts fell 4.5%. So obviously a lot of this due to the ongoing trade war, tariffs that we see hit the auto sector incredibly hard. But some analysts in Bloomberg as well saying that part of this could also be a lot of plants in Ontario were kind of retooling, changing their strategies. We saw a lot of plants setting up to have more production of EVs in the future. And then some of those started to change their plans. That's just an example of some of the retooling that happened. So that might be part of the reason there was less shipments going out for a little bit while they restructure. But at the same time, you could also argue that that restructuring was because of the trade war and the tariffs we saw. So incredibly interesting numbers, I guess you could say today when we're looking overall. Overall imports fell 1.1% in January and overall exports fell 4.7%.
All right, and one-on-one, like the U.S., other countries, how are we looking?
It's interesting. We'll start with the U.S. Obviously, the U.S. is our largest trading partner. So when it comes to the U.S., Canada saw a trade surplus narrow to $5.4 billion. So exports dropped 3.8%. Imports were down 3.4%. What's interesting is when you look at other countries, excluding the U.S., right? So Canada saw imports from other countries actually increase by 2.1%. Most of that is manufacturing equipment coming in from China. But when you're looking at exports from other countries, not including the U.S., you saw that drop to 6.5% after reaching a record high last year. And that's basically because we weren't shipping as much wrought iron gold to the U.K., which if you remember before, we were shipping a lot. And so exports were up. So it's interesting to kind of see these numbers. A lot of analysts saying that this shows, we might be off to a bit of a weak start in 2026, but things could change. And obviously what we're seeing, things can always change. And what we're seeing with oil right now, that could really boost Canada's exports in the future, because obviously we produce and export a lot of heavy crude. And what we're seeing today and what we've been seeing the last couple of weeks, we could see a boost in that sector at least.
Yeah, 2026 feels like the weather. Give it 5 minutes.
Interesting. Exactly.
And it's going to change.
Yeah.
Right? We'll see what happens. All right, Lindsay, thank you very much for that.
you.
BNN Bloomberg's Lindsay Biscay. Well, Canadian gold company Aris Mining Corporation reported record revenue, stronger gold production, and a sharply improved balance sheet. Full results after the break. Aluminum prices have hit their highest level since 2022 as the war in the Middle East continues. Prices have climbed above $3,500 per ton, driven by supply chain disruptions. Aluminum has surged since the start of the conflict in Iran, which has impacted supplies in the Persian Gulf, which accounts for about 9% of global output. Shares of Algoma Steel are sharply lower, 10% right now, after the company missed revenue estimates and reported a wider loss of $365 million in the fourth quarter. The Canadian steelmaker says tariffs weighed heavily on results, noting it paid more than $60 million in direct tariff costs during the quarter. Tariffs have been pressuring the company since they were first announced, with Algoma saying in December that it would eliminate roughly 1,000 jobs. Shares of Bird Construction are rallying up nearly 4.25%. The company posted net income that topped expectations in its latest quarter, as well as adjusted earnings that beat estimates on the downside. On the downside, construction revenue fell more than 6% and missed consensus due to the impact of previously disclosed delays. Taking a look at the markets right now, the TSX, it is off nearly 0.7%. Another red day for it. Similar situation when you head down to the U.S. Everything in the Middle East having an impact right now. Look at those numbers. S&P 500 off by 1.25%, Dow by 1.4%, NASDAQ by 1.6%. Aris Mining reported a strong set of financial and operating results for 2025, including record revenue, higher gold production, and significant improvement in cash flow. Joining us now to break down the results is Taylor Combaluzier, Vice President of Equity Research at Red Cloud Securities. And Taylor, thanks very much for joining us.
Yeah, thank you for having me on today.
All right, what numbers, when we're looking at this, what numbers do you like? And I'm going to ask you what numbers don't you like, but which ones do you like first?
Yeah, we'll start off on the ones that I do like. I think positive to see the gold sold was higher, than produced. That helped the adjusted earnings come in at a good price. The revenue amount up 19%. Over the quarter, that was very positive. That flows all the way down to those adjusted earnings. As I said, those beat both our estimates as well as those on the street. Some numbers that, nothing's too bad this quarter, but there are higher cash costs. And that's really just associated to how Aris sources its ore. They do largely have their owner-operated mines that are producing the gold, but they do derive about 35% of their production from Segovia, from contract mining partners. So those are smaller scale partners. And the costs associated with that style of mining are higher, and it is tied to the gold price. So a higher gold price will result in higher cash costs on that front. But ultimately, not a huge concern. There's still, the AISC margin is still very positive and increasing as we go through. So I think overall, extremely strong quarter. The production, which was pre-released, was a bit lower quarter over quarter, and that was due to an unplanned shutdown in November, but it was brief and ultimately didn't have much impact on the financials as we came out of that. So overall, as you said, very strong quarter for Aris.
And just out of curiosity, do you know how much the cost has gone up for the outsourcing, if we can call it that?
So that's not overly published, that exact formula as to how they tie that to the gold price, but it is, directly correlated to that. If we, look at the cash costs on the quarter, it is up about 9% on the quarter. So you can kind of look at that, compared to the realized gold price, which was up over 21% on the quarter.
And now, if gold prices were to drop, would they still look good to you? All things aside, but how are they? Does it feel like they're running a tight ship there?
Yeah, I think so. They're really starting to hit their stride. At Segovia, for example, they just finished expanding the plant and they're currently ramping that up. Right, kind of coming out of 2025, they're running at about 2,600 tons per day. We do expect them to hit the steady state of the 3,000 tons per day by the end of the year. That operation's been operating for quite some time, so we don't expect any issues on that front. And then if we look at their other mine that's producing Marmato, we do expect continued performance from the small flotation operation right now. And then at the end of the year, we are expecting their CIP plant to come online, which will process ore from the bulk mining zone. So that's their big expansion project that they've got underway right now.
All right, and they've got some cash sitting right now. What, at $392 million? Is that where a big chunk of that's going, or do you see any other M&As coming?
Yeah, so we do expect a lot of cash to go towards that. They do have another payment from their Wheaton precious metals stream of $42 million that they'll get that will help contribute to that Marmato capex. They have about $220 million left of that, and as I said, a $42 million stream payment that's going to come in once they hit the 75% spend milestone. We do expect a little bit as well. To go to Segovia again, just ongoing capex and expansion mine development type of stuff, and then taking a look at Toro, Peru. They're doing a PFS right now that we're expecting to be released in the second half. So there's a bit of spend there, but they might be looking to make a construction decision there in the first half of 2027. So obviously they'd need to have some cash for that as well. But they're continuing to make lots of cash. They've got lots of cash. They're in a good position right now is the bottom line.
All right, and their production target is 300,000 to 350,000. They were at 256 this year. That was up 22% from 2024, or in 2025, they were up at 256,000. Are those realistic numbers? Are they achievable?
Yeah, certainly. I mean, as I said, the Segovia plant is ramping up well. It's already up at the end of 2025 and continuing kind of at the same levels this quarter. And it should be hitting that 3,000 by the end of the year. Marmato, again, we're expecting that to contribute as well. They're looking at 35 to 50 for Marmato, so that'll help, and that'll largely be back end weighted. So we are expecting, maybe the first half of the year production might be tracking more towards what we saw last year, but they'll make up for that in the second half as the other operations come online and ramp up.
Okay, we'll wrap it up there, Taylor. But thanks very much for joining us.
Yeah, thank you.
Taylor Combaluzier is Vice President of Equity Research at Red Cloud Securities. Coming up, Canadian space tech company MDA Space just debuted on the NYSE. We'll talk to its CEO, Mike Greenley, after this. Canadian space tech company MDA Space debuted on the NYSE today, officially entering the U.S. stock market with an IPO announced days earlier. Here to talk about the details of the new move for the Canadian company is Mike Greenley, the CEO of MDA Space. Mike, thanks very much for joining us.
Thanks for having me. Good morning.
How's that first day going for you?
It's going okay. There's just lots of conversations, of course, leading up to an IPO and a new listing. You end up talking to a lot of investors, so it's been a week of talking, but it's been going really well down here.
Now I'm looking at things that you're oversubscribed on this. What does that tell you about the interest?
Lots of interest in the space sector in the United States market. There's a lot of space companies in the U.S. The space market is expanding rapidly globally, and we're a strong part of that. Within the space market, you have a wide range of companies. Some of them are startups. They're pre-profit. Whereas in our case, we're a 57-year-old company. We've delivered technology into over 450 missions during those 57 years. We have strong growth, strong persistent profitability, strong cash generation. So we're quite an attractive space stock in this community.
And why did you feel it was important that you moved down and to the NYSE and not, like, say, the NASDAQ and move down to the States in general?
Yeah, I think whether it was NASDAQ or NYSE, there's not a lot of difference there. We just picked NYSE for, just a series of small reasons. But it's in terms of why generally, it's really to get access to the U.S. investor. There are more space companies in the United States in the capital markets. As a result of that, there are more investors that are aware of the space economy, of space companies, the competitive dynamics, what the real growth opportunities are. As a result of that, folks are, giving higher valuations. They're willing to invest and really see the potential in space companies. And so it makes sense for us to be a part of that. We had a decent amount of U.S. investors as it was, but it's still a bit of a limit for people when you're only traded on the Toronto Stock Exchange for them to easily invest in you. And we want the full capability of the space investment community to be able to easily invest in us, which caused us to make this move.
All right, there's virtually no discount on the share price. Did you think about that before going public with it?
Oh, we certainly considered how much popularity we would have, and if a strong discount was going to be required. In the end, due to the strong popularity in the stock, the oversubscription that you mentioned multiple times, oversubscribed, we were able to really focus. We only put out a limited capital raise on this at $300 million. We were very intentional about this, very disciplined. We did not want to intentionally dilute our existing investor base very much at all, and so this is going to cause like a 8 to 9% dilution type of a thing, and as a result of that, that'll be regained quickly with the amount of enthusiasm that is seen around us, and it's provided a very successful entry into the U.S. markets.
Why was it important to cap it at that and not dilute the investors that are already there?
Just because we didn't really need the capital right now. We wanted to raise some capital that allows us to be able to enter the market more efficiently. It encourages banks to pick up coverage of us, and we would like more coverage of our stock from the U.S. banks. We will succeed in that as a result of this maneuver. Having a small amount of capital can be helpful just to further strengthen the balance sheet. We have about $100 million right now on our revolver, our line of credit. We'll pay that back quick. Have a couple $100 million in the bank. So we're in a very, very strong position from a balance sheet perspective, which will give us a foundation to be able to, consider acquisitions as we move forward into the future. That's another benefit of the U.S. stock, is that we're able to transact when we consider acquisitions using cash, as we have done in the past, and or using stock in U.S. stock.
All right. Now, the first day is the fun day. It's the exciting day, ringing the bell and everything. Then you have to come back for day two. What's the focus? Who do you see as your competition? Is it SpaceX, or do you see yourself working with them? And what do you see as your next step?
Yeah, for us, it'll be to continue to build our relationships with the U.S. investors. That's really happened well as a result of this U.S. IPO opportunity. The large majority of the investors that have been participated in this equity raise round have been U.S. investors. A number of those have been long-only investors. So nice, stable U.S. investors that really appreciate space stocks. And so that's been excellent for us. We'll continue to nurture those relationships, introduce ourselves to more investors, participate in the various conferences and forums that exist down throughout the United States, and engage this investor community moving forward. And that's what we'll do. Meanwhile, back at the ranch, we will continue to operate and expand the business globally. And we have a strong organic growth path ahead of us. We have a $40 billion pipeline of opportunity to pursue over the next 5 years. So we'll be busy engaging with that, looking for our next round of orders. While strategically, we consider acquisitions in the U.S. or Europe to be able to cause ourselves to further expand inorganically as we go through the next couple of years.
And so but just going back, and SpaceX, do you see yourself working with them? Do you see them as competition? And are you
on SpaceX? We work with SpaceX for launch. Certainly when we contract for launch, we often use SpaceX for that partnership. in terms of competing directly with SpaceX, I think some of our customers, you would say, compete with SpaceX. We have one of the world-leading digital communication satellites in our MDA Aurora product. We've just completed a new factory in Montreal, which will have the capacity this year to start producing 2 satellites per day, 400 satellites per year in high-volume production. We'll be selling those satellites to customers around the world that need to build broadband data networks to provide internet-like data services globally, and also for direct-to-device communication networks to talk directly from satellite to cell phone. Those networks will, in many cases, compete with SpaceX's networks. So we're enabling those network providers to have the latest technologies produced in high-volume manufacturing globally to be able to win that competition.
And I just want to sneak in one last question. 6 decades almost in Canada. Are you going to stay headquartered in Canada? And you talked about acquisitions. Is there any chance that you might be acquired?
We will stay headquartered in Canada. I think that the Canada Investment Act would have a lot to say about us ever being acquired. We are generally viewed as a strong, important asset in Canada with the new defense investment strategy, clearly identifying space as a sovereign capability area for defense in Canada, with Canada wanting to produce its space solutions in space in partnership with Canadian industry. All of those factors would work together to keep us as a Canadian headquartered company. But we will continue to expand globally and have delivery and, in some cases, manufacturing capability in other countries so that we can build them some sovereign assets as well for their space interests.
Okay, Mike, thanks very much for joining us today. We appreciate it.
Thank you. I really appreciate it. Have a good day.
Cheers. Mike Greenlee is CEO of MDA Space. Just ahead, following Prime Minister Carney's trip to India, Japan, and Australia last week, he's on yet another trade mission adventure, this time to Norway and then the UK. We'll have more on the plans after this. The war in Iran is quickly becoming an economic crisis, and it's all about oil and shipping, with Iran targeting vessels in the critical Strait of Hormuz. CTV's Joy Melvin has more in this report.
The Strait of Hormuz, a lifeline for global oil, now a war zone. Iran unleashing new attacks on shipping tankers, effectively cutting off 20% of the world's oil.
They have no radar. Their leaders are gone. And we could do a lot worse.
The U.S. president says they've hit Iran hard, blowing up Iranian vessels suspected of laying mines in the strait.
We took out just about all of their mine ships in one night.
But as energy prices skyrocket, sparking fears of an economic crisis, an urgent effort to keep prices down. Oil-rich nations agreeing to the largest release ever of its oil reserves.
Our countries will be making 400 million barrels of oil available. I repeat, 400 million barrels of oil.
Hoping to calm markets and nerves, Canada, too, working with its allies on energy exports.
Canada will do its part to contribute to the world's supply. That will bring prices down for Canadians. That will keep prices affordable for Canadians.
Meantime, the president, who calls this war a short-term excursion, also says he's not done with Iran yet. That's not going over well with key Trump supporters who feel betrayed.
He ran on no more wars and these stupid, senseless wars, and then we have one that we can't even really clearly define why we did it.
This, as reports suggest, the U.S. was to blame for that tragic strike at an Iranian elementary school, killing 170 people, mostly school-aged girls. An early military investigation says it was likely due to outdated intelligence. The president was asked about it.
I don't know about it.
With the new supreme leader, Iran insists it alone will decide the war's end, as the FBI now warns that sympathizers or proxies could try to launch attacks on U.S. soil.
And that's CTV's Joy Melvin. Well, following Prime Minister Carney's trip to India, Japan, and Australia last week, he's out on another venture, this time to Norway and the UK. For more on this, we were joined earlier by CTV's Jeremy Sherrill.
Yet another trip for the Prime Minister. He'll make a stop today in Yellowknife before traveling abroad. That announcement, or that stop, is expected to be an announcement surrounding defense, some kind of defense announcement in terms of protecting the Arctic and northern regions of the country. We'll get more details later today. And then he embarks on a trip to Norway that will be also focused mostly on defense. The Prime Minister, while in Norway, is expected to observe a NATO exercise alongside the German Chancellor as well as the Norwegian Prime Minister. That is an exercise in enhancing NATO's Arctic capabilities, Arctic defense capabilities, one that only happens every couple of years. About 25,000 military members taking part in that exercise. While in Norway, he is also going to have a bilateral meeting with the Norwegian Prime Minister. They're expected to talk about a number of things, including foreign investment, clean energy, critical minerals, aerospace, and AI. He'll also spend time with the Nordic Five, the leaders of Iceland, Denmark, Sweden, Finland, and of course, Norway. They'll talk about a number of things, including trade and bolstering cooperation in the Arctic. After his time in Norway, Andy, he's also going to make a stop in London, in the United Kingdom. He will meet with Keir Starmer at 10 Downing Street. They are expected to talk about the situation in the Middle East, as well as the situation in Ukraine, two conflicts, global conflicts, where the UK and Canada are very, they see eye to eye. They have very similar positions on how to move forward and how to provide support. That will be the end of the Prime Minister's official itinerary. But he is staying in Europe on personal time, we're told by the Prime Minister's office, until March 22nd.
And that was CTV's Jeremy Sherrill. Market Call is coming up next. Today on the show, we have Stan Wong. He's portfolio manager at Scotia Wealth Management. And we'll be taking your questions on North American large caps and ETFs. Let's take a look at the markets now, see how they are shaping up. Another down day for them. The TSX off by 0.55 right now. Pretty much every index in the red. Hardest hit healthcare down 2.4 almost, and materials up by 1.5. A couple are in the green though. Utilities up 1.14, and energy up by about a percentage point. South of the border, S&P 500 off by a point, more than a point, and the Nasdaq is off by 1.35. That's it for Morning Markets. Thanks very much for joining us. We'll see you tomorrow.